When I first started doing seller financing and I first started doing lease options and things like that, I thought that was the way poor people did real estate. I probably had 200 units or so before I was at a seminar once, and I just happened to sort of mention my portfolio, and somebody came up and said, "No, you got to tell me how you did that." And I started telling them about how I did seller financing and some lease options. And I look up and I've got like 100 people standing around me all taking notes.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 283. One of the reasons people never pull the trigger to invest in real estate is that they believe they won't qualify for a loan. But what if there were a way to acquire property without ever stepping into a bank or passing a credit check? Today's guest bought his first 400 units using techniques that allowed him to sidestep the banks and work directly with the seller. He now has over $100 million in assets under management, and he's sharing his secrets with us today. Bill Ham is the author of Creative Cash, the complete guide to master lease options and seller financing for investing in real estate. Bill, welcome to the show.
Thank you for having me, Brian. I appreciate it.
Tell us a little bit about yourself and how you got started investing in real estate.
Absolutely. Yeah, I've been in real estate coming up on 16 years now, a little over 15 years. I started in 2005 with the duplex. That was my very first deal. Before that, I was a pilot, corporate pilot by trade, flying airplanes. Figured out that really just wasn't the career path for me, and that I really had more entrepreneurial spirit than employee spirit. Not that there's anything wrong with the job, it just wasn't for me. And so I closed the duplex and walked away from the aviation career with a duplex. I had... Not that I recommend you do that, by the way, but I had saved up $10,000, cash flowing about $300 a month. That is, if nothing broke. And that was my first deal. And I thought, man, I'm a genius. I'm out of here. And so I turned in my 2-week notice and went directly into real estate full time on $300 a month. Found out very quickly I was not as smart as I thought I was. I did survive it. I did get out there and build a portfolio despite my shortcomings there. But I was 28 years old, no kids, no real debt. So that's the carve out there. It was easier for me to just sort of go into real estate full time. So it was the right move for me. But first 402 units, actually, I was able to accomplish with some form of creative financing, be it a lease option, seller financing, debt partners, lines of credit cards, even, you name it. I got out there and figured out a way to get it done. But that's how I got into real estate, and then ultimately started syndicating deals and getting into larger commercial assets, which is what I do now.
Tell us with that first duplex, what creative financing technique did you use to take that down?
Seller financing, actually. It was a good friend of mine who gave me a high loan to value, very little bit of money down, seller financing. And I was able to own it for a seasoning period, which means the time in which a lender is going to want to see you own something and allow you to refinance it without using the original purchase price for the value. Because, when you go in to borrow money from a lender, they always say you're going to put down, let's say 20% of the purchase price or the appraisal, whichever is lower. Now, if you owned it for a little while, then there is no purchase price. And so I got my friend to seller finance it for me, put down a little money, kept it for a while, then refinanced into a long-term loan, and still actually own that property today. I've bought and sold dozens and dozens of other deals, and that one's still hanging around, still sitting there.
What a great start. And I think you called it the seasoning period,
Correct.
And just explain that to our listeners.
That's a technical term. So seasoning period, again, means how long you have to own something for a lender to let you refinance it and essentially pull money out.
Mm-hmm. So how long was it for you Was it a
Right,
12
you could
month?
refinance something every week if you wanted to,
Mm-hmm.
but the most lenders would not allow you to do a cash out refinance. So that's the seasoning period.
So did you have to own it and operate it for 12 months before you could do the
I
cash out
didn't
refi?
actually, and there's the carve out. This is the good old days of lending, sort of pre-08 crash, and I think I owned it for about 120 days and was able to refinance it. Now let me stop that right there. These days, you're probably a year to 18 months. So if anybody is considering doing the BRRRR model, the buy, renovate, refi, and repeat, that's great. But just keep in mind, you're probably going to have to own that thing for a year to 18 months before you're going to be able to pull cash out. Those are the good old days before the '08 crash, and lenders learned to get a little more savvy with their lending. Back then, money was pretty free and easy.
And just to hang on that first duplex for a moment,
Sure.
What was your friend's position in it? Did he owe money to the bank? Was there an existing loan? Did he own it free and clear?
And that's also a big catch with doing seller financing specifically. He owned the property outright. So he had full equity. It was a partner of his and my friend, and they were rehabbers and flippers. And so they would go in and basically buy cash money property, put their cash into it, renovate it, get it up and running, put renters in it, and then they would sell the property. Well, I was getting into the business, and so they had this one ready to go, and I thought, great, seller financing and everything. So that's how I got into that one. It then, went on to become the rehabber and seller myself. So I got in and started doing what they did, which was find distressed assets, fix them up, bring the value up, either refinance them or sell them.
Did you seek out knowledge on these creative financing techniques and then go apply them? Or was it the opposite, where you found opportunities and realized the only way you could take them down was through creative financing?
Yeah, more of the latter. I didn't even know what creative financing was. I was just figuring out ways to get deals closed. I didn't know what a lease option was. I didn't know they call that seller financing. I was just making stuff up because I had no more job. I had no money and no experience and no real credibility. So it was a choice of figure out a way to accomplish the business or go get another job. So I was just out on the street, just making stuff up every day. I didn't know about creative financing. I didn't have my book. I didn't have other things to teach me that. I mean, I had the books that basically taught me real estate, the general real estate business, but I was making up the creativity as I went along. Funny story, I actually used to be embarrassed to talk about it. When I first started doing seller financing and I first started doing lease options and things like that, I thought that was the way poor people did real estate, and that everybody else was just, writing checks and they're just buying real estate and they're putting money down. And that's the way normal people buy real estate. Everybody's got money, everybody but me, right? Everybody just closes, and I'm over here, doing seller financing and this sneaky stuff. And I felt, I felt dumb because I thought everybody else did it the right way, and I was out here just making stuff up. I probably had 200 units or so before I was at a seminar once, and I just happened to sort of mention my portfolio, and somebody came up and said, "No, you got to tell me how you did that." And I said, "Okay, fine." And I started telling them about how I did seller financing and some lease options. And I look up and I've got like 100 people standing around me all taking notes. And that was the day that I went, "Oh, aha, this is interesting, and and there is value here." But I was embarrassed to talk about that for a long time.
Well, let's talk about your second deal then. Even though you weren't really sure what it was, you used creative financing to take down your duplex. What was the next deal, and how did your creative financing work there?
The next deal was actually houses. And about that time, I started to borrow hard money. So I would go and get hard money loans or pool together hard money loans. And I say hard money, really, I should probably call it something more like firm money. Because in the beginning, I was borrowing money from people that were more like friends and family. So they were not professional hard money lenders. I did ultimately use professional hard money lenders, but in the beginning, it was a lot of friends and family money. And what I would do is just pool together small piles of cash and then go out and purchase 3, 4, 5 houses at a time with cash. And then once I had all the houses sort of up and running and renovated, I would then refinance at a bank and pay back all of the lenders. And that was my main strategy for doing a lot of the business, whether it was seller financing or I used my credit cards or I used friends and family money or any of those things. The idea was to get in there, stabilize the asset, bring the value up, and then either sell it or refinance at a local lender you're paying back the original loan, and therefore getting into that long-term bank finance where I could then hold and operate the portfolio for cash flow. And that's what I did. So I did the duplex, then I did houses for a little while. My first sort of real multifamily, I had some triplexes and some quads, but the first one was like 9 units. And then I did a 20 unit, and then a 27 unit, a 44 unit, 108, 152, and then on into some several hundred units. So again, small, steady beginnings. I did not just jump into multifamily. I started off like almost everybody, houses, flipping houses, doing small real estate that I could get started in. And with time and experience, they got bigger and bigger, but I did not go big quickly.
And were you doing this during the Great Recession when you could find all these bargains, or was it leading up to? I mean, what was the time period?
Yep, all around that on either side of the '08 crash. Yeah, so I started in '05, and the market was still going pretty good there, still pretty hot, inclining market. This was in Macon, Georgia. So that's about an hour and a half south of Atlanta. It's not the most affluent part of the world. So there were always sort of deals, or more correctly to say, there were always people with problems. And that's what I love in creative financing, is because the main concept is to get results by creating value for a seller through your offer, through your efforts. And so there were always sellers in the Middle Georgia area that needed some kind of help, some kind of operational help, some kind of distress of some sort. So even when the market wasn't great, because it was great, and like it is today, super hot, hard to find deals, that was sort of leading up to '08. And then after the '08 through 2012 or so, the market was still pretty soft in Middle Georgia. And so I was able to get a lot of those deals. That's very indicative of market cycles. And that's something that I teach a lot of my students is market cycles. It cycles just like the economy, sort of up and down, up and down. And you just watch your cycles and take advantage of the down cycles.
And during this period, you mentioned you were finding firm money, not hard money, but firm money. Was that coming from friends and family? And
right.
How were you convincing them to loan you this money during that period when everyone was scared that the bottom was falling out of our economy?
Yeah, exactly. Relationships is the first answer. So I had good relationships. Outside of that, one of the best ways that I convinced people to lend was by making sure that they understood that the mortgage was backed up by the asset, and that they were safe in that regard. That was probably one of my larger sales pitches. And then quite frankly, it was just a little bit of track record. Once I had done one or two and I had shown some success, just had a little bit of a track record, it was kind of like what I call the Jones effects. Keep it up with the Joneses. My lenders would go tell their friends and family about all the money that I just made them. Well, of course, their friends and family wanted to know how, and then they wanted to get in, and then they told their friends and family. And all of a sudden, all the Joneses, everybody's trying to keep up with the Joneses, right? And they all wanted to lend me money because I was making good returns for everyone. So just took a little credibility, a little bit of experience. And then once I got 2 deals, 3 deals down, smooth sailing from then on out.
So it became a status symbol to be loaning you money.
Yeah, correct. Bragging rights, I assume. And I was making pretty good money for these people. So of course, everybody likes to brag about making money.
What kind of returns were you getting for them?
I was usually paying about 12% usually. Again, sort of hard money loans. The reason I say firm money instead of hard money is because from a hard money lender, they're professionals. They know to charge you points going in and points going out and high interest rates and these kind of things. Borrowing that money from friends and family, they didn't know the lending business, so they didn't have all those different fees and different things. But I was paying them a really good return. It was just simple interest. It wasn't a very complicated loan like you may have with a hard money lender.
So, Bill, before we go on and talk about other creative financing techniques, tell our listeners why the traditional financing route, why you avoided that for so long. I mean, I think you've explained some of that, but
right.
What are there other issues with traditional financing that you were trying to avoid, or why wouldn't someone just go to a bank and get a loan?
Well, my honest answer to that question is you should. If you can, you should. If you've got a piece of real estate that is a good real estate, it's a good area, it's in good condition, and it's cash flowing, and you can go to the bank, qualify for a loan, put some money down and buy that property, you should. That's the best way, the most easy, traditional, stable way. But if you were like me, like when I got started, I wasn't avoiding the banks. The banks were avoiding me. I had no money. I had no credibility. I had no net worth. So really for me, qualifying for that loan was the issue. It wasn't that I had a negative opinion of using traditional financing. It was fine. I just had no credit, no credibility, and no money. So they weren't too thrilled with me. And that's what I find a lot of people are in that position, attempting to get into real estate for the first time. They may be able to find a deal. They might be able to find assets, but paying for those assets is a challenge. And so that's why I've kind of brought out the book that I've written now, and I'm bringing out this creative information now, because it's going to help a lot of people on both sides of the fence. It's going to help a lot of buyers get into real estate that may otherwise not have been able to get into due to the barrier of borrowing traditional funds. And it's going to help sellers. I'm predicting a market downturn for a number of reasons. And I believe there are going to be sellers out there over the next few years that are going to need some help getting out of some of those deals that they got into. And I believe some people have made some mistakes. Maybe they overpaid. Maybe they bought real estate they didn't understand. And they're gonna be motivated sellers. And so creative financing is going to be a very important hallmark of our businesses going forward, although it hasn't been over the last 3 to 5 years.
It sounds like you're anticipating is this a economic downturn or a downturn in the housing market? And it sounds like what you're saying is that there may be some investors who have gotten in over their heads by over leveraging and maybe running their numbers a little too optimistically. Go into a little bit more detail on this downturn that you're anticipating.
Well, as I said, I've been through the last large recession. And so I know what these market cycles look like and what comes with them. Now, what you have to understand is I'm not discussing the federal legal term definition of 2 months GDP. I'm not talking about the actual definition of a recession. I'm talking about a recession cycle. Because if you go back and look at the 08 recession, it was really very short-lived, some months. We went through a technical recession at the beginning of 2020, kind of the COVID recession there. But I'm not talking about the technical recession. I'm talking about the market cycle that sort of follows that. Because if we remember back in 08, yeah, the recession may have been some months, but the markets were sort of resembled that effect for several years. And that's sort of your market cycle. So yes, we can discuss market cycle on an economic level, on a real estate level. You can discuss it nationally, on a state level, a city level, right down to your own neighborhood. So market cycles are not necessarily in sync. So we can discuss the economic recession. Yeah, I think economically we're going to have a little bit of some issues going forward. I think we're going to see some inflation. We could have an hour-long discussion just on that topic alone, obviously. But I think that we're unfortunately going to see a split, a bifurcation in our economy. And the upper class and the lower classes are going to have a wider gap between them, I'm afraid. And I think what that's going to entail is actually a split of the economy. They call it the K-shaped recovery. I'm kind of saying K-shape. I'm not going to use the term recovery. I think the upper class, talking about real estate specifically, the A's and the B's. And remember, we have A, B, C, and D assets. So A and B being your newer, C and D being your older. I think the A's and the B's are going to recover and go up. And I think the C and D, the affordable housing market, may decline separately. And we may actually have two different real estate cycles going forward. The upper class real estate and the lower class real estate, which have never really separated before, but I think they will going forward.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. It sounds like you anticipate that separation and that distress in the C&D assets to create opportunities that would be ripe for creative financing?
Correct. And that's why I'm kind of telling everybody today, I think there's too much risk in the affordable housing market for a number of reasons. I think the prices are too high. The returns are too low for that asset class. And the killer is what I call the CapEx tsunami. And this is something that I really don't see a lot of people talking about. We have a real problem with the older apartment complexes in America. They're getting old real fast. And it's going to make these assets unmanageable at a certain point in time. If anybody listening owns a property that was built in the 1960s or the 1970s, you're probably worried about plumbing, roofs, and subflooring. Those are probably your big areas right there, And so there's the catch is in the C space. I think we're turning a blind eye to capital expense costs. And so what I am predicting is a lot of people have overbought, paid too much, therefore over leveraged, which most time that's a problem when the sort of the values decline. I'm saying this time it's going to be a problem when your building gets really old and you just can't keep up with the capital expense repairs anymore. It's not cash flowing. You're not making any money. You're literally all the cash flow is going down the drain, the plumbing, right? And that's going to cause for some motivated sellers. Not when I say crash, not a crash like '08, everything just falls apart and the values of the world collapse. I don't think that's going to occur. I think we're going to have a decline in prices, and it's going to be most visible in the affordable space due to the age of the asset. And so that's where I think we're going to have a lot more opportunity for creative financing going forward. Reason being, the lenders are going to pull back. There's just not going to be as much traditional financing. If you've got an older building, the occupancy may be a little off, maybe the property's distressed, it needs a fair amount of repair and maintenance, and you go over to Fannie or Freddie or somewhere to get a loan, I believe they're going to lower your loan to value significantly. And I believe they're going to make you put up large reserves in order to take care of the repairs on the property. And I think bringing all of that cash to the table is really going to hurt the returns on that property. And the only way to fix that is lower the price. So that's kind of where I'm predicting a downturn in the affordable housing space.
Yeah, well, as an investor who has about a third of my portfolio with properties that are over 100 years old,
same here.
I can tell you that aging infrastructure applies to the internal workings of the building too, and you're spot on with the plumbing and the issues that you have with those older properties.
I would rather have a property that was 100 years old than one that was 50 years old. They don't make them like that anymore. At least you had that old brownstone construction, 100 some odd years old. They really made property well back then. What I have found from my experience in the business, it's when we really got into the affordable housing construction. Around the 1960s, late 1950s through the 70s is when the post-baby boomer era is when America really started to build a lot of larger affordable apartment complexes. And the construction is pine frame wood construction. And that's how they really started to mass build these apartments quickly and cheaply after the World War II era. Yeah, that was great. But 50, 60 years later, those things are coming due. That the infrastructure is just getting too old, and it's really going to be expensive to try and maintain those. And so that's why I'm saying, hey, let's be careful about the C space. But at the same time, I think there's going to be a lot of opportunity, a lot of great deals to purchase there. And let's do it when we can kind of share some of the risk with the seller, i.e. seller financing, master lease options, some sort of creative financing to help that risk.
And let's get into those topics now. You mentioned that your first multi was a 9-unit. Tell us how you took that down. What kind of creative financing did you use?
Yep, that actually was a second seller financing. So I was able to get some seller financing on that one. Pretty tough area, pretty tough little property. And the owner was one of my favorite scenarios, just a burned out landlord. The property was okay. The asset was fine. It really wasn't in need of a lot of repairs. It was just a pretty management intensive area. And this guy just had enough, he just didn't want to deal with toilets, trash, and tenants anymore, and was burned out. And of course said, well, as most landlords do when they have a problem, they say, well, I'll just sell the property. Well, we were in that cycle where there weren't a lot of buyers. There certainly weren't a lot of buyers for that neighborhood. And there was very little debt that you could get on that kind of property. So there's where the seller had a problem. And that's how I negotiated getting seller financing out of that individual was I always blame it on the bank. Hey, I'm good. I got a lot of cash. I can qualify for the mortgage, but that evil bank just won't give me a loan. And why? Because they don't like your property. I'm sorry. So I always play that good cop, bad cop, and the bank is always going to be the bad cop for me when I'm talking to a seller. And that's how I negotiated, again, seller financing out of that one. But I got seller financing and then did repairs and did renovate some of the units on credit cards. So that was kind of a double whammy there. Then I was able to refinance and pay the credit cards off. I don't recommend that, by the way. I was working hard. I got the deals done, but that was probably a bit risky. I don't mind admitting.
Well, I want to talk about master lease finance or master lease options. First of all, what is master lease option? And then give us the explanation of how you worked it into your deals.
So a master lease option is technically two separate documents that just come together to create this overall concept of the master lease option. And the short version of this is we are going to go in and rent a property with the right to sublet the units, meaning to rent out those units. And at the same time, we're going to pick a price for this property in an amount of time in which we have to buy the property. So I usually find the easiest way to explain this is sort of use an example. So let's say, Brian, you have a deal and you're burned out for whatever reason. You need to get out of this property, but you have a mortgage. See, now there's the catch. If you have 100% equity, I would move for seller financing. If you have a mortgage in place, you really can't give proper seller financing because you can't convey title. You have a mortgage. So in that particular scenario, that's when we would do this master lease option. And so the master lease portion of the contract gives me the right to rent your property, Brian, with the right to sublet to your tenants. Okay, why that part? Well, that gives me the ability to control your asset, the management, the cash flow, the operations. So if you've mismanaged that property somehow, I'm going to use that side to come in, maybe hire a better management company, maybe become the management myself, fix up your property. But I don't want to go do all this work for free. So what you and I are going to do is in our option agreement, the second part of this contract, we're going to pick a price. We're going to settle on a price today. And then we're going to pick a time frame in which I am the only person that can buy that property for that amount of money, which is our option to purchase. So I'm going to take over management and control operations. And then I'm going to control the sale and for how long with the separate contract. So the whole point is I'm going to come in, rent your property, Brian, do the things you couldn't do, maybe bring some money you didn't have, fix your property up. Let's say you and I agree to a price of $1 million. The idea is that, and let's say, $1 million and I have 3 years in which to buy the property, we'll just say. So my concept would be to come in and try and bring the value of your property above the $1 million during this option period and get it up and running. And then I purchase the asset from you at $1 million, but now I've made it worth $2 million. So that's the idea, is to sort of rent, or if you want to call it borrow, a property from a seller, bring in the elbow grease and the time and the energy to get that property up where the seller didn't or couldn't. And then you have that price locked in at the early price of what it was once worth. And then you can sell it, wholesale it. You can do just about every exit strategy except refinance. You cannot refinance out of a master lease. So that's kind of a 10,000 foot view of what a master lease option is.
And you can't refinance because why?
You're a renter. You're simply a renter. So you are not on title with a master lease option, because let's say, like in our example, Brian, you didn't sell me the property. Now, had you done owner financing, we would have gone to the attorney, would have done a closing. The title would have transferred to me. You would have a lien on the property just like a bank would. And if I didn't pay you, then you would foreclose, but there would be a transfer of title. So I'm now the owner of your property. I can refinance that because I'm the owner. But if I simply rent your property with the right to buy it someday, there's nothing to refinance because I never bought it, So there's the key with a lease option. Don't think that I can take your property down for $1 million and then make it worth $2 million. And then I'll just go borrow, $1.8 million against the $2 million and pull out 800 grand. No, it's not going to work that way. When you go to buy the property, it's going to be just like I said in the beginning of this call. It's going to go back to whichever is lower, your purchase price or the appraisal. Well, in this case, hopefully it's the purchase price. So you're still going to be buying and borrowing on the $1 million value, but you're borrowing on $1 million when the property's worth $2 million. So that's why you want to do that. Now, you could then own it, seasoning period, refinance it and pull money out. You could do that. But that's the reason we can't immediately refinance.
Yeah, that's a good explanation. I've always loved this strategy, and I've never employed it myself, but I do have some questions about it.
Sure.
If you're on a master lease option and you're leasing that space, so let's say it's a 12-unit apartment complex, you're essentially leasing those units at the value at which the seller is receiving for those units, right?
Correct. The leases would all stay in place. Mm-hmm. So now when, over time, let's say like in our example, you've given me a 3-year lease on your property. Well, the leases with the tenants would probably only be 1 year. So as those leases came due and renewed, I could raise the rent on those tenants, but my rent to you would not go up. So my payment to you in a lease option really should only be 3 things. Ideally, I should cover your mortgage, your taxes, your insurance so that you're break even. But I don't really want to give you any more than that, because if there's positive cash flow, that should come to me as the operator and the one doing the work. Again, a lease option is just to maybe stop you from going into foreclosure or help you out on a property that you couldn't deal with. But I want to keep the cash flow. I have shared in the cash flow with sellers. So in reality, every now and then you do kind of have to share some of that cash flow, but ideally speaking, you don't. So again, my lease is with you and the complex. The complex leases, those units out to the individual tenants.
So what do you do if you have a vacancy or an eviction during that period, or a major repair that's going to require a lot of capital? How do you account for that in a master lease option?
Great questions. They are technically yours to deal with. So that is one thing you have to understand with the master lease option, is that you are now, if functionally and essentially, the new owner operator. So there was actually several different questions in there, and a few of them have different answers. So normal day-to-day operations, evictions, tenant turnover, all of that sort of stuff, that is for you to do. So you as the new operator, you're going to collect all the rent, you're going to pay all of the bills on the property, then pay the mortgage, the taxes, and the insurance, for the seller, and then you keep any positive cash flow above that. So you are taking care of the day-to-day operations. If there is an incident on the property, that could be considered something covered by insurance. Fire, flood, blood, something like that occurs in the property, that would be covered by the seller's insurance policy. But what if it's a normal wear and tear breakdown? The plumbing is just leaking. Well, that's not something the insurance is going to cover, and might be beyond your ability to pay for it out of cash flow. That's an issue. And so a couple of comments there. When doing a lease option, you go through due diligence the exact same way as if you were going to buy the property. You need to know everything that's right and wrong in that property, and you need to budget a capital expense for that example right there. So if I were looking at your deal, Brian, and I said, gosh, man, this thing's really got a lot of bad repair and maintenance items, I may create a capital expense budget for myself. And either I'm going to bring that money the day I take over the property, I'm going to bring that money to the table to do those repairs, or I'm going to set it aside from cash flow and create a savings account for the rainy day repair item.
So if you do a master lease option, what kind of money do you have to put down? How much money do you typically set aside? because you do have to have that cushion to cover those expenses, those operating type expenses for the rainy day fund.
Yep. So a couple different questions. All right. So one, let's just take it from the perspective of capital expense reserves. Typically in older buildings like Fannie and Freddie will make you put up about $250 per door. So on older buildings, I would recommend about $500 per door, $500 per door per year in a reserve for repairs and maintenance. So that's kind of an answer as far as budgeting for just the day-to-day fixes. Now, completely separate amount of money is what we call the option money. Now, that has nothing to do with repairs and maintenance. That is more like an earnest money deposit, like you would put down if you went and bought any property. So you have option money, and the option money is what you're going to give the seller as a deposit that will be applied to the purchase price when you exercise your option and close the deal. That money will also be a default if you don't exercise your option and you don't close the deal. So it's kind of your incentive to make sure that you go through the deal. Now, here's my formula for how much money should you put down in an option. Well, there's a technical answer and a less technical answer. The less technical answer is as little as possible, but as much as it takes to get the deal done. So obviously we want to keep as much cash in our pocket as possible. A technical answer, the way I decide how much money to put down on any particular deal is I only want to put down about half of what I believe the entire property will cash flow for the entire time that I'm going to be there. For example, our deal. If you and I decided that it's $1 million for your property and I have 3 years in which to buy the property, I would sit down and calculate up what is the annual projected cash flow. And I would only want to pay you about 18 months or half of my 3 years worth of cash flow. Now, why do I come up with that number? Because remember, if we get to the end of this deal and for whatever reason we don't want to close it, that deposit or the option money is a forfeit. Yeah, but so what if I've cash flowed it all back? I really am not in any particular risk at the end of the deal. And that's a great way to keep yourself safe while doing lease options. One of the largest ones that I ever did was a 108 unit complex. And after about a 3-year window, actually a little over 3 years, I decided not to exercise the option. We had found, my partners and I had found all kind of structural issues, water coming in under some of the buildings. Yeah, things just made us decide we didn't want to buy the property for the option price. So we walked away. The option money was a forfeit, but I had cash flowed that back twice over, in that time. So I didn't care. And that's why I kind of say, hey, there's your formula. So that, does it always work out where you can put down exactly half the money? Maybe, maybe not. It's just a reference. The idea being you really want to cash flow back anything you put into the deal and try and put down as little as possible, but you need to be negotiable and get the deal done.
Take us through a real world example, whether it's that 108 unit you just mentioned or a different property. Take us through like the negotiation period, how you get the seller on board with this concept, and then the numbers and how it worked out for you.
So yeah, the 108 unit, that's an easy one to tell that story. So first off, what you want to do when you're looking at any kind of deal is to come at it from what I call the SPY perspective, the SPY technique. That's an acronym and it stands for Seller Property U. That's how you want to analyze a deal. Sit down and look at the seller first, because 90% of a good deal is seller. 10% of it's real estate. If you don't have a good seller and they're not willing to do business, you probably don't have anything. So what motivates the seller? What's going on with the seller? What do they need? What do they want? Let's solve that problem first. Second, we move to the property and we say, okay, what's going on with the property? Is it distressed? Is it occupancy? Whatever. Then lastly, you kind of figure out, does this deal work for you? Most people make the mistake of kind of going at it from what do they want. Then they look at the property and then as an afterthought, they think of the seller, and that's a mistake. So in this particular 108 unit, the backstory here was the property had actually been on the market for a little while with a realtor. And what was going on was the management company, who was a very large professional management company, not some little overnight management company, a big company. They were operating this property, and like any good management company, they collected the rent, paid themselves first, and then they started paying the invoices for the property. And when they'd run out of money, they just take all the extra invoices and throw them in a drawer. Start over the next month, pay themselves first, then start paying the invoices, run out of money. Oh, well, throw them in a drawer, start over the next month. Well, after some months of this, the property really started getting shut down. The plumber and the painter and the carpet people and all the vendors wouldn't show up to work on the property because they were all owed money. And so finally, the management company, and this is unbeknownst to the owner, by the way. And finally, the management company calls up the owner and says, "Oh, by the way, we just need you to stop by and write a check for $50,000 so we can catch up the operations and go back to work." Well, of course, the owner hit the ceiling with that one. Hadn't been cash flowing forever, and now they ran the property 50 grand in the hole and surprised him with the invoice. He was livid. So the negotiation basically went where I looked at the asset and said, you know what? There's really nothing physically wrong here. Not really. It was operational. And so that's when I realized that I just need an opportunity to take over the operations, and then I can get the thing running better and straightened out. Well, so me pitching the seller on just being the next management company, he wasn't interested because he thought, well, this management company did a bad job. Why are you going to do any better? And so that's when I said, okay, let's do a lease option. I wound up putting up $75,000 as far as it was a $5 million option purchase price for the property. I put up $75,000 as far as option money was concerned. And in my math, I figured it was going to take about 2 years to cash flow that back. And I actually cash flowed it back in just a little over a year. So did real well with that one. Cash flowed like crazy for a few years, and then walked away from the option and didn't actually close it. And the seller was able to sell it, but not to me. So that's basically how I got in there. I had one of the catches with that deal in particular. I had to accept the $50,000 in bad debt on that property as part of the deal. So I got to sit down with all the vendors and all the contractors. And
is that in addition to the $75,000 that you put down?
Right. So I had to deal with that 50 grand. So what I did was I sat down and started, I studied collection law, first of all, and figured out who could be paid, who didn't have to be, what was the law. And I just went through all the vendors and negotiated each and every one of the payments. What I did mostly was by now I had several hundred units in the city. So this 108 unit deal brought me up to a little over 450 units or so in that area. And so what I did is I sat down with all the vendors and said, okay, like the pest control company, for example, I said, okay, I owe you $1,000, $2,000, whatever it is. I can write you a check and you're excluded from my entire portfolio, or you can erase the debt and I'll give you an exclusive agreement to service my entire portfolio. And so 9 out of 10 vendors actually took that deal and forgave the debt. And then I gave them exclusivity to my portfolio. And I made probably 40,000 out of that 50,000 just go away, and then paid the rest of it off. So yep, that's how I did the deal. And that's just piece of business.
The creative debt repayment.
Got to make it up. Just making it up every day to make it up.
How did you deal with the management company that was in place? Does the master lease option give you control over the property that you can bring in your own management system?
It does. Yes. So the master lease, not the option, but the master lease gives us, again, we're renting that property. So it allows us to control operations, including, yes, the management company. I fired them on the spot, is what I did. That's how I dealt with them. I told them to kick rocks, but I had a management company, and that's the other side of this. Is I owned a management company. I had staff and I had people working for me. So we just came in and took over the management. But that was the only reason that I did that deal, was because I knew I could come in and with my team and my staff, we could operate that property better than the management company that was already there. So I probably would not have done that deal if it was just about firing that management company and just hiring another management company off the shelf, unless I was already working with a management company that I knew would do a good job.
So you decided not to buy that one when the option period came due. Give us another example of a master lease option that you would consider to be your greatest success.
One of my greatest success, and it really wasn't a monetary success, more of as a social success. One of the last ones I actually did, I had 4 units, 2 duplexes in a pretty bad neighborhood. And I just didn't feel like spending the money on them. The neighborhood had gotten pretty tough, pretty high crime. There was a lot of vandalism. And so it got to where it just didn't really make a lot of sense to go in and try and renovate these units. Every time a tenant moved out, we'd basically have to go in and completely renovate the place. And the rent just really wasn't high enough to be worth the trouble. So I kind of looked at it and said, well, it's probably cheaper to actually abandon the real estate than to keep sinking, capital into it when it's not really making much revenue to begin with. Just stop spending money on it, write it off, and just make the mortgage payment. Don't worry about it. And so what I did, though, was I was working with a church that actually rented another house of mine. And I went to the church because I knew they were running a battered women's shelter. And so I did a lease option with the church. And basically what I told them was, look, you can have free rent because I basically have abandoned the place. You need to go in, fix it up and maintain it and get the property back up physically together and keep it together. And then you can use it for your battered women's shelter. And that's what they did. They went in, they took over the property. They managed it quite well. They moved in, women that were part of their program, and I got a good tax write-off. So that was probably one of my better successes. Again, not necessarily a financial success, but I think all in all, it worked out very well for both of us. I got a headache taken care of. My property was maintained, which kept me out of hot water with the lender. Right. My bank wouldn't want to ride by and see that I abandoned one of their assets. They don't think that's too funny. So this was good because it kept my property, maintained, and it didn't cost me any money anyway. And it helped out some people. So I think that was a success.
So how did that work with the tax write-off? Because it sounds like you still owed money to the bank.
Oh, I did. Yeah, sure. I mean, I get write-offs. I'd take it as a loss, so I was showing no revenue on that asset.
You were able to pay off your loan with cash out of your own pocket, I'd assume.
Well, yeah, correct. Yeah, I was already making a loan payment anyway. And that's in that particular scenario, I had sort of decided to abandon the unit. In a different scenario, what I probably should have done and would recommend anyone listening to do was I should have had the church basically just make my mortgage payment, and then they get access to the property. But I didn't own the real estate for all that much longer, so it really wasn't a problem. But yeah, that's how you can get in deals, you can get out of deals, you can do all sorts of stuff. So I've given creative financing, I've received a lot more of it, but I've been on both sides, seller and buyer.
How do master lease options work now? I mean, the real estate market as we're speaking now, which is early 2021, is still red hot. Is it difficult to get sellers to agree to lease options or master lease options in this climate?
It is this afternoon, and it has been over the last 3 to 5 years. That's why that you've probably not heard a lot of these techniques and you've not seen a lot of material on this. Reason being, creative financing is used to solve problems. And that's something I need everybody listening to understand. Creative financing is not meant to give you an ability to buy real estate when you have no money, no experience, no credibility. That's not really the point. You need to bring value to a seller. Well, the seller needs to have a problem. Have sellers had problems over the last 3 to 5 years? Not really. Because if they had some issue, they probably could just park the property on the market, get asking price plus money, or more than asking price, because the market's been so hot. So there's been too many options available for sellers. I am predicting going forward, again, for a number of reasons, those options to stop being available to a lot of sellers. Debt being the biggest one. Always watch your lenders. Your lenders are the ones that drive the market cycles. And so as we see lenders tightening up criteria, that's an impending downturn in the market. And so what you'll see, and I saw it in the last recession, you'll see it again, is lenders have a flight to quality. When the market gets a little weird, the world gets a little weird, the first thing lenders start doing is they stop taking risk, which means they will not lend on a distressed asset as readily as they have in the last couple of years. When lenders stop lending so much on those older distressed assets, it makes it more expensive to buy that deal, which means the values come down. And that's where I'm predicting that we're going to see a lot of opportunity coming up. One area. Another area that I think we're going to see a lot of opportunity where there has not been any, but will be, a lot of people got short-term debt over the last couple of years, bridge loans, short-term financing, things of that nature. And I think a lot of those loans are going to come due over the next 12 to 18 months. And I know a lot of people are planning on a big cash out refinance. And that's not occurring right now. That's just very difficult to pull off in the market, is cashing all your money out. Lenders are really not liking that. And so I think that debt coming due is also going to make a lot of motivated sellers if the market continues to shift like I'm expecting. And there's a lot of other reasons, COVID and collections and things of that nature. But I believe we're looking at not a crash, but a downturn. And that's where we'll have the opportunity.
Bill, tell us about your book, Creative Cash. Why did you write this book? And why should our listeners buy it and read it? What are they going to get out of it?
I wrote the book, again, because of exactly what we're talking about right now. It's time for the material to come out. It would have been untimely for me to put this information out 2-3 years ago, because I think the techniques would have been almost impossible to use. They're market specific, creative financing. Although you can do creative financing, and I have done creative financing in all market cycles, it's more prevalent in a down cycle. And I believe we're headed for a down cycle. And they usually last 2-3 years. And so that's why I believe that we're going to have a lot more opportunity over the next 3 years to use seller financing, lease options, and a lot of the other techniques that I have in the book. So that's why I wrote it, and that's why I'm releasing it right now, is because I believe we're at the top of the market. We're teetering at the top, and we're going to slide down the other side, economically speaking and real estate speaking, as you asked earlier. But yeah, that's why I wrote the book. That's why I brought it out. It's going to be a lot of techniques that are really going to be valuable going forward over the next 3 years or so.
Any parting thoughts for our listeners on creative financing, and employing it in their own strategy?
Yeah, be a problem solver. Really stop and think about creating value for a seller with your offer. And don't think only about your own needs and wants. It's really about the seller. Find somebody that has a need and create value through your offer. That's how you get creative financing, is seek to serve first, seek to create value for others first, and then you'll get the real estate in the business that you're after. And that's a very important concept. If you'll just take that one thought and the SPY technique, seller, property, you, and you'll go out and look at deals from that lens, you'll increase your chances tenfold of getting creative financing. And of course, get my book. That'll help too.
Yeah. Well, one more opportunity here. Plug your book and tell our listeners how they can get a hold of you or find out more about you.
Absolutely. The book is called Creative Cash. It is on Amazon, Kindle, and it is almost out on Audible. By the time this recording is played, it may be on Audible. So Kindle, Amazon, and Audible. Check it out. It's about creative financing and how the techniques that we could use going into this new market recession, how to get deals with little credibility and less money. Again, that's on Amazon. I have a masterclass. If you're interested in taking our masterclass on creative financing, that is at creativeapartmentdeals.com. So just go to creativeapartmentdeals.com and sign up right there. If you want to contact me directly, it's bill@gobroadwell.com. And my company's website is broadwellpropertygroup.com. If you're an investor, you want to do some business with us, look us up at broadwellpropertygroup.com.
Well, thank you, Bill. It's been great talking with you about creative financing techniques, seller financing, master lease options, always something I've been interested in doing. And I'm glad you shared that with us today. And it's also really interesting to hear your take on what you see as the coming multifamily real estate distress, not affecting everything across the board, but really kind of focused on the C and D properties. And then also those who have over leveraged and maybe have the short-term debt as opposed to long-term debt locked in.
Absolutely. Those are the ones to watch.
Yeah. Well, it's good to hear you say that. And I appreciate you sharing everything with us.
Hey, Brian, I thank you for having me. It's been a pleasure. Good to see you.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.